Success in golf, as in life, comes less from strength of body and more from strength of mind and character. Arnold Palmer. Welcome to the Mortgage Caddy Podcast, where we keep your mortgage game on par and your financial fairway wide open. I'm your host, William Ware, your mortgage caddy for all things home loans, commercial financing, SBA lending, and real estate strategy, with a special focus on the Florida and Colorado markets. Whether you're buying your first home, working with realtors, or building out your business and needing the right loan to play, you're in the right clubhouse. So let's start with a little bit of a backstory. After spending a little over a year in the lending trenches, I keep seeing a pattern. People stepping up to the tee box, ready to buy, refinance, or grow their business, but then they slice it straight into the woods because someone did not explain the hazards to them. Mortgage jargon, fine print, shifting interest rates, and market quirks in Florida and Colorado gets confusing. So I thought, what if borrowers, realtors, and business owners had a friendly caddy who could walk them through the course, explain the traps, read the wind, and help them pick the right club, or in this case, loan. That's what this show is about. It's part education, part strategy session, and part Clubhouse chat. We'll break down complex lending topics into plain English with a little golf humor thrown in, because hey, I can't help it. By the end of each episode, you'll leave with at least one insight you can use next time you're up at the tee. Okay, so today's market update. Let's talk about where things stand right now and what it means for buyers, business owners, and realtors, especially in Florida and Colorado. For interest rates, the average 30-year fixed mortgage rate in the U.S. is sitting in the mid 6% range. Some specific lender quotes are showing around 6.5 or so for well-qualified borrowers. However, forecasts for the rest of the year call for rates to remain above 6%. So how does this apply to you? For buyers, you're not seeing ultra-low rates that we had a few years ago, so your payment cushion is thinner. But you can lock something in now and strategize around it. For sellers and realtors, because rates are elevated, buyers may be more cautious, so homes that are priced well and move quickly will stand out. And for business owners looking at commercial or SBA loans, borrowing costs are still elevated relative to historic lows, so it's critical to shop lenders, assess all costs, and structure deals smartly. Florida versus Colorado nuances. In Florida, we're continuing to attract strong demand based on the sun, lifestyle, retirees, and relocations. So inventory remains tighter in many submarkets. That means that ready buyers with pre-approvals and flexibility have an edge. However, in Colorado, we're seeing more of a balance in some markets. Price appreciation has slowed in certain suburban and mountain areas, giving move-up buyers a chance, but you still need to act decisively. Across both states, the lock-in effect, owners staying put because their current rate is low, continues to reduce supply, which supports pricing. So, the summary, rates aren't plummeting, but they are stabilizing. The advantage goes to the prepared borrower, the proactive realtor, and the business owner/borrower who anticipates cost of capital rather than reacts after the fact. So let's dive into our first tip. Get a strong pre-approval and understand what it really means. Think of it like checking your yardage before you swing. You don't just eyeball it and hope you pick the right club. You measure, factor in wind, slope, and hazards. Same principle applies in lending. Why pre-approvals matter? Well, number one, it shows sellers or listing agents that you're serious. And in this competitive market, especially in Florida and Colorado, seriousness counts. Number two is it gives you clarity on how much you can borrow, what your payment will look like, so that way you're not bidding blind. And number three, it can surface red flags early, whether it's in your credit, your income, or your assets, or something else, so that you can fix them before you go under contract. So what makes a good pre-approval versus a weak one? Weak pre-approvals. You submit a basic application and the lender gives you a soft pre-qual based solely on a credit pull. A strong pre-approval, which is what I do, is I verify your income, your assets, and your debt, and I issue a conditional approval, sometimes called pre-approval, that looks almost like final terms. It's important to make sure it's current within the last 60 to 90 days, reflects the type of property that you're targeting, and gives a clear rate range, not just a vague, we may approve up to X amount. So if you're a buyer, pick 2 to 3 lenders, get a solid pre-approval this week, and understand your borrowing power. If you're a realtor, push your buyers to get this solid approval before showings. You don't want to lose the house because the buyer wasn't ready. And if you're a business owner, similar principles apply with any loan. You need to know your debt service coverage, collateral, personal guarantee implications, and treat your business loan like you would a big swing on the back nine. So now let's have a little bit of fun. I've seen some classic bad shots in the lending course, so here are 2 real-world mistakes you'll want to avoid. Mistake number 1 is waiting for the perfect rate and missing out on the property. One buyer told me, I'm waiting till rates hit 5% again. Meanwhile, the house they loved went under contract to someone who locked in a 6.25. The lesson, market timing is a gamble. Being prepared is your best swing. And mistake number 2 is ignoring the total cost and only focusing on the interest rate. I've had clients chase the lowest rate but ignore closing costs, mortgage insurance, property taxes, and especially for business loans, the fees. That's like choosing a driver club because it looks good, but neglecting the wind, terrain, and hazards. The lowest rate won't always win if the total cost and terms are not aligned with your goals. So what's next? Well, in the next episode, we'll tee off the 3 biggest mortgage myths that are costing buyers thousands, how to separate fact from fiction, what lenders are really looking for, and a few strategic plays to help you win. If this episode helped you, do me a quick favor. Subscribe to the Mortgage Caddy Podcast, leave a review, and tag a friend who could use a caddy on their loan journey. You can find me on Instagram at the Florida Mortgage Caddy or on YouTube, and you can find me on LinkedIn, Facebook, and Threads as William Ware Jr. And I drop snapshots, quick tips, and yes, more golf analogies. Until next time, keep your scores low, your credit high, and remember, every great shot starts with a great plan. This is the Mortgage Caddy Podcast. Thanks for tuning in, and I'll see you on the next hole.